It is tough out there. I mean, we have the lowest housing affordability level in 40 years, Michael. This has created a lot of pain in the market, a lot of people complaining, of course, about housing prices and housing payments when it comes to interest rates. It is less affordable. It's the worst it's been in 4 decades.
Jason, welcome to the show today.
Hey, Michael, it's good to be back. I know we've done several shows over the years, and I hope to share some good data with your audience today.
Well, this one of the things I love about you, Jason, is first of all, you've done this a long time, real estate, all kinds. You have several podcasts around real estate, and you're a data-driven person, and I love that. So today we're going to kind of look at a macroeconomic view of what's going on with housing affordability, mortgage rates, and then of course how that affects real estate investors. So let's start maybe with the crisis of housing affordability. Kind of what are your thoughts around that?
Yeah, it is tough out there. I mean, we have the lowest housing affordability level in 40 years, Michael. And this has created a lot of pain in the market, a lot of people complaining, of course, about housing prices and housing payments when it comes to interest rates. It is less affordable. It's the worst it's been in 4 decades. And many people thought that this would lead to a market crash, but they made a fatal mistake in that prediction because since the interest rates went up quite dramatically starting 2 years ago, we have only seen prices continue to appreciate. And I should just caution, there are many segments of the real estate market. We are talking about housing. We're not talking about multifamily apartments, which are struggling in some areas. We're definitely not talking about office space, which is really, really struggling in most areas. We're just talking about single family houses. And that's the asset class in which I specialize and my company specializes.
Yeah, having said there's a lot of similarities though between rental housing as well. So whether it's an apartment or a single family house, the availability of affordable housing is a problem in our country, and because of the cost of construction, you can't build affordable housing anymore. Maybe you can, but I haven't heard anything yet. Therefore, you're really only building Class A luxury housing of some sort. And so, well, shoot, there's no more affordable housing you can build, and there's a population that's growing, and so obviously that's going to drive the prices up. Though I would agree with you, I think the rise in interest rates should have done something much more devastating to the market, and it has not happened. People are either not selling, volume is way down, or they're paying the higher prices just so they can actually get a house that they want.
You know what? You just alluded to it. You just alluded to one of the major keys about why everybody has gotten it wrong about predicting a housing crash. And that is that they viewed it based on affordability of new people entering the market rather than how they should have viewed the market based on all the existing homeowners who control the existing housing stock that aren't willing to sell. This has been the key to what has gone on in this very different type of market we're in. So, Michael, I'll share a couple of charts on this, if I may,
Yeah, they're
that I
great.
think will really be enlightening to your audience. And let me just put that in screen share mode. So this is the thing. If we look at a chart of the national payment to income ratio, when we saw interest rates climb in the post-COVID era, where we had already seen housing prices climb quite dramatically. Now, everybody got that wrong too. They thought housing prices would crash with COVID and so forth. And, they had their reasons, and, some of them made a lot of sense. But just as an aside, okay, on the COVID era, what a lot of people fail to think about is that we live in a centrally planned economy. We have a government and a central bank that exercise huge power over the market. And they do this in coordination with other governments and central banks around the world. So they always have a reaction to every crisis. And their typical reaction is loosen the money supply, open the floodgates, drop the dollar bills from the helicopter, whatever metaphor you want to use for that. That's the Ben Bernanke, helicopter Ben, they called him, helicopter money. And that's their response to any crisis. And a lot of people predicted a completely devastating housing crash during the COVID era. The complete opposite happened because, of course, they loosened the money supply and opened the floodgates and, dropped the money from the helicopter. But after that happened, we saw prices run up quite a bit. And we all know the story. And then we saw interest rates rise dramatically, the most dramatically ever in history, making high housing prices plus now high mortgage rates make housing very unaffordable. And if you look at the payment to income ratio on this chart, you see that it became very, very high. The last time it was this high was in some of the 1990s era where things weren't too good either. And then, of course, into the 80s when we had extraordinarily high interest rates as Paul Volcker, the Fed chair at the time, was trying to break the back of inflation. And he did succeed in that, but it was a painful success. And a lot of people suffered with those high rates during that time. Here's the problem, though. What all of the crash predictors and all of the doomers and all of the crash bros, as I like to call them, what they saw is they viewed only new entrants into the housing market. Now, when interest rates went way up, sales volume went way down. So since we saw the rate hikes about 2 years ago, we've had a much lower volume of sales. Only maybe 8 million, give or take, homes have transacted since then. At a normal clip, we would have seen maybe over 12 million transact. Now, the housing stock in the United States consists of about 140 million housing units. So all of the doom and gloomers looked at the 8 million, and they keep looking at the 8 million who have transacted since the payment to income ratio got very ugly, and they think, wow, we should have a crash. And with that myopic view, they would be right. But what they didn't count on is the other 132 million people that control the housing stock and the potential inventory. And they're not selling because they have too good a deal. Guess what they have? They have this scenario where they locked in on these 30-year fixed rate mortgages at these extremely low rates, and many of them before the prices rose. So their payment to income ratio is extremely comfortable. It's the complete opposite, Michael, of the people that came into the market later. So what this is doing is it's increasing the wealth gap, and it's making people very angry. The people that missed out, that didn't have the confidence, that were running the script of doom and gloom during the COVID era and even the slightly post-COVID era, they missed out and they're angry. And so they're all over social media. They're all over, X or Twitter, and they're posting about it, and they're angry at the baby boomers and yada, yada, yada. And the rest is history, as they say. But that's what happened. In a nutshell, that's the crux of the issue.
It's a real problem. I mean, at the end of the day, for investors, is this good or bad for investors? You own rental properties or even multifamily, driving up rents, right? Is it good for investors or is it kind of bad for investors?
Well, that's a great question because investors have more dimensions to their thinking, hopefully, than just prices. If anybody watching or listening thinks that real estate is a one-dimensional game of buy low, sell high, they are really missing out. I mean, look, you can make money when prices are declining in real estate. There are all kinds of ways to make money in this beautiful multi-dimensional asset class, the most historically proven asset class in the entire world, the most tax-favored asset class in America, and because we love using leverage properly on our real estate deals, the most debt-favored asset class in America. So it is a multidimensional asset class. There are many ways to make money. And when sales volume declines, as long as the population is either stable or increasing, And by the way, let me make a little side note to that. A lot of people look at population, and that is somewhat myopic also, because population, of course, does matter. Because that represents the demand side of the equation when it comes to housing. Everybody needs a place to live, right? But what really matters more immediately than population growth or stagnation or decline is household formation. And what we have to do is we have to lag population by about 25 to 30 years. So, what counts in terms of the real estate market is what happened 25 or 30 years ago, not what's happening now. And we are seeing a bit of a baby bust, okay, where the population and the marriage rates are declining. And I think this is a serious problem for humanity. Now, of course, the lefty environmental movement who thinks that humans are the scourge of the earth and they're ruining the planet, they probably love it. But I personally like people, and I think people actually provide resources and ideas and knowledge that solve problems. So I want to see the population at least maintain itself, if not increase, because one of those people that hasn't been born yet might be the person that cures cancer or does whatever great thing for the rest of humanity and the planet.
What is your outlook for interest rates? I mean, there's a lot of obviously debate around that stuff. What are your thoughts?
Yeah, so Fannie Mae, obviously the biggest mortgage player in the entire world is Fannie Mae, right? Nobody is bigger in the mortgage world than Fannie Mae. And Fannie Mae predicted at the beginning of the year, and remember, that's just a few months ago, okay, just several months ago, they predicted that by the end of this year, we would see mortgage rates at 5.6%. Now, the bad news is, I don't think that's going to happen. Okay. At the beginning of the year, it did look like that because, Jerome Powell was talking about the Fed pivot and, how, he was giving clues that they were really going to ease up. Right. But, inflation has been a real beast. And to combat inflation, the Fed keeps rates high so that the money supply is tighter and people spend less. And he's been trying to increase unemployment. He hasn't done a very good job of that. Just know, folks, the Federal Reserve wants you to lose your job. And so what they're doing at the Fed is they're in a very tough spot, Michael. They're playing what's called the Phillips curve, which I'm sure you know about, but maybe not everybody listening knows about. And that's the relationship between inflation and unemployment. And unemployment is too low. They want to make it higher so that people will tighten their belts and not spend so much. And if they reduce spending, that will tame the inflation beast. But it has been very, very stubborn. And that's why rates are still high. And look, we don't know when they're going to lower the rates. If I had to guess, and interest rates are extremely hard to predict, it's one of the few things that in the last 20 years on my podcast I've been wrong about, which is interest rates. I would say that knowing that I've been wrong about it, I'm going to still predict. I would say that 5.6% Fannie Mae prediction has probably been postponed for about 2 quarters. And we'll probably see that second quarter of next year, somewhere in that range. And when that happens, I'll show you another chart that will blow your mind. Okay. And this chart is what happens to the number of people who can buy houses when rates decline. Okay. So let me just pull that one up, Michael, and share it with you here. Okay. So take a look at this. This is our own internal research. Now, if we use 7% as a baseline for mortgage rates, because we have to start somewhere to compare things to, we'll go with 7%. If rates drop by 50 basis points and we see 6.5%, that means that 2.8 million additional people will now qualify for a mortgage. If they drop to 6%, 5.4 million new potential entrants into the real estate market. And if it goes way down to 5.5, this is why this is green, because this is likely to happen, and this is a little less likely. That's why it's yellow. Okay. Then 7.7 million new potential buyers are in the market. Now, of course, not all of them will buy, right? So say here maybe 1 million people come into the market, about a third. Here, about 2 million people come into the market. Here, maybe 2.5 million people come into the market. Well, how much housing inventory do we have? We only have about 550,000 homes for sale in the United States. Imagine just the smallest drop occurs and another 1 million people, give or take, come into the market and start bidding on the existing very low inventory of 550,000 homes for sale. I mean, we all know what's going to happen. Prices will be pushed upward.
So this drop in interest rates, half a point or even a point, is not going to materially increase the supply, is what I'm hearing you say. So the people who aren't selling because they have a 2% mortgage
constrict the supply. Yeah.
Right. So we have all these new people that are coming in the market, and the supply is going to be about the same, maybe a little bit more, but not really much. So the prices are going up, is what I'm hearing you say.
Oh, there's no question. Look, the only way we solve this problem is either we work on the supply side by building more homes, or we work on the demand side by having less people. I mean, it's pretty simple. This is not a complex thing. And it's very difficult and very sticky to create new housing supply. There are all sorts of environmental restrictions. Every city, every municipality has its issues. And then, of course, like you mentioned earlier, just the simple cost of construction and construction materials, all of those ingredients for a house. The house I'm in my mom's house right now, right? Behind me, you see what? You see glass, steel, lumber in the walls. You see copper wire. You see petroleum products, concrete below me. All of these raw materials are not indexed to any one currency. They are traded globally. They have intrinsic value, regardless of whether they're traded in the dollar, the euro, or the yen, doesn't matter. And they are needed by every human being on earth because everybody needs shelter, everybody needs housing.
So it's a good place to be as an investor if you're, if you're looking to buy right now, or you're trying to figure out what's your advice to real estate investors or even homeowners? Like, should they wait? Should they buy? What should they do?
Well, for homeowners, is your question, should they sell their existing home and then buy a new one?
For example?
Yeah. Okay. So the dilemma they have is that the delta between the new mortgage rate they would get and their existing mortgage rate is so big that they're just not interested in selling.
Yeah.
25% of the people in the country have a mortgage at or below 3%. 65% of the people in the country have a mortgage at or below 4%. And remember earlier, we talked about the housing stock being about 140 million people. Well, 42% of those have no mortgage at all. There is just so little motivation for people to give up their home and buy a new one that it's just constricting the market. And so we have a very unusual situation. We have a situation where people are more motivated to improve the existing home they have because now the world has realized that their mortgage, that super cheap mortgage, is a big asset. And they don't want to sell that mortgage asset because it cannot be replaced.
Now, what about people looking for housing, right? I mean, what we've seen on the multifamily side is that demand for rental housing is unprecedented because it's actually cheaper to rent and to buy. There's even, especially some young people, like, you know what? I'm never going to buy a house. That's dumb. That's stupid. And then I got to cut a lawn and look at all the hassle. And then who knows, son, I'll lose it. I'm just going to rent for the rest of my life. It's much more affordable. I don't have any worries. So someone who's looking for housing, there might be asking, well, should I rent or should I buy? If we're saying, hey, if interest rates are going to probably go down, maybe not a lot, but go down, therefore prices are going to go up. If I want to build equity or wealth, it seems to me like if one can afford it, one should buy a piece of real estate.
Yeah, look, I will be the first to agree that housing is expensive. And there's no shortage of complaints, especially by the millennial generation and now the Zoomer generation, the Gen Zers that are coming after the millennials. But the first thing they've got to realize is that things are much better than the picture they paint and the media paints. Here's why. The typical millennial that is the primary driver of the housing market right now. I mean, the oldest millennials are not kids anymore. These are 43-year-old people. Okay. They are definitely adults, even if they're refusing to grow up. Okay. What they're on the slow life plan. Okay. They're doing everything later. They are forming a household later. They are coupling up and getting married much later, if at all. They are having kids later. They're doing everything more slowly than their baby boomer parents did. So the narrative in the typical millennial's mind, and remember, this is the biggest demographic cohort in American history. So you got to talk about them. Okay. The baby boomers were only about 76 million Americans. Their children, the millennials, are 80 million. Okay. So it's a giant economic force. It matters for sure what the millennials are doing. But the millennials complain that they say, look, my parents, when they were 30 years old, they could afford a house, and I'm 30 years old and I can't afford a house. Okay. And so that's their gripe. But what they never look at is the fact that they went to Europe, they became a digital nomad, they sort of screwed around, they didn't get too serious about their career. They have been enjoying life and avocado toast. And, their parents didn't do that. And their parents coupled up sooner. Their parents got pregnant sooner. They had kids sooner. They did everything earlier. In fact, that gap in time is about 6 years. So the accurate comparison is to compare a 30-year-old baby boomer with a 36-year-old millennial. And when you do that, you find that they're really at about the same place economically. And the millennials need to stop complaining so much, okay? Because things are much better than they would have you believe. So that's an important thing to consider. Go ahead. Yeah.
Well, affordability. I've heard people say that because of this affordability, it may actually cause a rental crash of some sort. Rents can't continue going up because people can't. But I'm thinking the same. How can that people need to live somewhere, so what are people going to do? Just not live anywhere anymore? But I understand the problem, right? It keeps going up, and I can't afford it. I can't afford it. But would rents ever go down because there's an affordability problem?
No. Look, the marketplace does not care about the affordability problem in buying or renting or anything else for that matter, or the price of hamburgers. I mean, the market is the market, okay? And the market dictates the price. And when someone pays a price for something, that determines the value, period. Okay. It doesn't care how unreasonable anybody thinks it is or how unaffordable it is or woe is me. The market doesn't care. Okay. The market just moves on and goes to the next person who's willing to pay. Look, another thing the economists really just don't understand is the idea of capitulation. Right now, for example, would it surprise you to learn? It probably would. It probably surprised everybody to learn. It surprised me when I started researching this. Would it surprise you to learn that the percentage of transactions right now of real estate transactions by first-time buyers is the highest it's been in many, many years? Over 58% of all homes sold right now are sold to first-time buyers. The same people who are complaining like crazy, right? Here's what people don't realize is that, look, everybody knows you would have been much better off buying a house 4 years ago. Heck, you would have been much better off buying a house in 1972, okay? But so what? At some point, everybody just capitulates. They take reality as it is. They'll complain about it. They'll pause because of it. They'll say, hey, we're going to try and time the market. We think there's going to be a housing crash because affordability is too low, prices are too high, interest is too high. But eventually, they just finally think, look, I want to get on with my life. I want to buy a house. Okay. And I'm not going to get the same house I would have been able to buy 4 years ago. It's just not as good. But I will eventually come to terms with the reality of the market, and I will capitulate and I will just buy what I can buy. And that's the way it is.
Yeah, I see developments like pad splits, for example, which I find fascinating. I think this is kind of response to what you're saying. The market, market doesn't care. So people are basically, they're bunking up with 5, 6, 7 other people, or 11. Their landlords are basically converting. Yeah, they're converting all livable space into a bedroom, right? So there's like 8, 9, 10 bedrooms in a house, and now the rents are much more affordable. And for the landlord, it's fantastic. It's like short-term rentals was to the normal house. All of a sudden, you're changing the use of a house. And I think it's fascinating. And as investors, we're constantly trying to figure out, how do we adapt? How do we take advantage of what's going on? And I think this is a great example of that.
Absolutely. No question about it. People just come to terms with the reality. I mean, look, it would be like this. Think of it this way. If someone is out there and they're thinking, okay, I live in Nebraska, right? Nebraska is not that expensive, right? Or I live in Kansas City, cheaper market, right? Or I live in Memphis, less expensive market. These are all places we've done business over the years. But by the way, my company, Empowered Investor, we help people buy properties nationwide for investment. Okay, they buy single family homes mostly for buy and hold long-term rental. And so we do business in all these different markets around the country. We see them firsthand. We know what the boots on the ground, real world experience is of landlords in these markets. But say, for example, someone's moving from an inexpensive market and they're going to move to Los Angeles, where I grew up, or they're going to move to New York City, right? Very expensive markets. They're going to accept less. That's the reality of it. You're not going to get the same home in New York City that you had in Memphis. In Memphis, you had a nice single family home with 3 bedrooms, 2 baths, and a 2-car garage. And now you move to New York City, you'll be lucky if you get a 600 square feet efficiency unit. Okay. That's reality. So that same kind of scenario applies to the marketplace as a whole. You know, 4 years ago, you had that big, nice suburban home. Now you're going to get a smaller, lesser home for the same monthly payment. That's just the way it is. And eventually people just come to terms with it.
That's been always fascinating catching up with you, Jason. How can people find out more about you and the Empowered Investor?
So my main website is just my name, jasonhartman.com. And then you can find my podcast or YouTube channel out there. Just search my name on YouTube or any podcast platform.
Dude, enjoyed it. Great having you on the show today.
Thanks, Michael. It's always great talking to you, and happy investing to you and your listeners.